What's going on, guys? Welcome back to the channel. In this video here, we're doing an analysis on Apple. Loading this up in the stock research tool, we're going to take a look at our company metrics category first off, and taking a look at our 5-year averages to compare them to the trailing 12 months so we can gauge where this company is going. So with Apple, our average 5-year PE ratio is 23.49. We're currently sitting at 23.16. It's not bad. Massive improvement on our EPS, as we can see, from 3.46 up to 6.20 right now. Huge return on equity. Massive. That's absolutely massive. Profit margin is also up. So first 4 boxes here, very impressive with Apple. Our revenue is currently sitting at $386 billion. That is absolutely insane. We do pay out a very small dividend, folks, 0.62, which works out to be $14.5 billion paid out to shareholders. And that's no problem because our average free cash flow is sitting at $68 billion. And right now, for the trailing 12 months, it is currently sitting at $105 billion. That is phenomenal. Look at this return on invested capital, folks. Our average is 31.39%. Currently, we're at 53.50. A phenomenal Allman Z-score, sitting at 6.78. We want to see this number over 3, and we have that no problem, as well as our Piotrowski score is sitting at 8. Now, let's jump into our financial evaluations category. Now, what we do here, folks, we grade the company out of 10 by looking at the cash flow statements, the income statements, and the balance sheets to get a score. So with Apple, we are scoring it a 7 out of 10, folks, and we'll go through these categories right here to figure out what everything means, so to see what they're doing right and what they're doing wrong. So with Apple here, as we discussed, our 5-year PE average is sitting at 23.49. Now, it's not terrible. We want to find companies that are underneath 22.5 because we want to find a fair value for those companies. Now, a 23.49 PE ratio is not the worst thing, and most likely they can justify this higher PE ratio if they can continue to grow the way they're growing. So, but with that in mind, they are not getting awarded points for that category. The current ratio is also a point where we're being deducted because it's sitting at 0.93. We want to see this number over 1.5. That means that they have enough assets on hand to cover their liabilities. So this could be a potential issue going forward. Where they are going to get some points though, a return on equity average 78.13. We want to see this number over 15%, folks. A healthy return on equity is always welcomed. So 78.13%. EPS growth is up by incredible amounts. Well, look at this other half of the categories, all green across the board. Our debt to equity though is much to be desired, 172%. Is not looking too great, folks. That means they're taking on more debt to grow this business and not growing the business through equity. And with interest rates going up, folks, this could be a potential red flag. Actually, to be honest, or retract that statement, it is a red flag. That's one of the biggest red flags I've seen with this company. Our current ratio with our liabilities that we have on hand, as well as our debt to equity, those are some big red flags because, listen, you want to find companies that have the least amount of debt as possible, which is interesting to think about with Apple because they have so much free cash flow. I'm wondering why they would want to carry this debt. And with interest rates rising, this will be an issue, folks, so just keep that in the back of your head. On the other side of my financial evaluations, green across the board in a lot of key categories that matters. Share dilution, they are buying back shares. That means you as a shareholder, you are owning more of the company if they keep buying back the shares. The only discretion I have with this is if those shares are overvalued. If they're overpriced, not a good sign, but if they're undervalued, this is great. That means they're using the free cash flow effectively. Our net income is growing. Our free cash flow is growing. Our return on invested capital is over 10%. It's very high. And our revenue growth is 11.7% up from the last 5 years. This is a $2.36 trillion company, folks. And they are crushing it in pretty much every aspect. The only things that we have a discretion that really bother me based off what I'm seeing here is our current ratio and our debt to equity ratio. I can live with this PE ratio, but I'm loving all of the growth here, and especially the trifecta of the net income, the free cash flow, and the revenue growth. with that in mind, I'm going to go do a price analysis. This is another section of my software here where we're allowed to analyze a company from 1 to 20 years. And we can try to price out what we should be paying for this company today to try to assume a fair value. So I'm going to jump in and I'll fill out these boxes and we'll touch base in just a quick second. If you're enjoying the video so far, folks, make sure you hit that like button and subscribe button. I post investing videos every Monday, Wednesday, and Friday. So jumping into the price analysis section here, what I did was to assume revenue growth to not be as aggressive as possible. I like to stay on the conservative side. So I know we've grown in the last, let's say 10 years, 10, 11, or the 5-year, and so on and so forth. I want to assume a lower revenue growth number because, look, this is a $2.36 trillion company. I can't assume the same revenue growth and that much higher over the next 10 years. It just doesn't make sense. Actually, let's change that to 10. It's at 20 right now. So it doesn't make sense for me to assume a super high revenue growth number. So I'm discounting that to give myself a decent margin of safety. Profit margin and free cash flow margin, however, I did pick numbers that I believe that they can hit based off the consistencies that we've shown over the 1, 5, and 10-year numbers. So I did 21, 21.5, and 22 for our profit margin, 24, 24.5, and 25 for our free cash flow margin. Makes sense based off the numbers that the company has shown us that they can clearly do. With our price to free cash flow and PE ratio, I left it at 14, 16, and 18. 14, 16, and 18 just to reflect a lower number because, well, why not? And our desired return, we did 13%. So let's click calculate. I can't speak today. Let's click calculate and see what this comes out to be. So our average calculation comes out to be 128.76. Current price is 145. So our average, aggressive average, if you believe this 9% revenue growth number, then it'd be a buy at 155. 139 on our DCF calculation, so pretty much call it 140 if you will. But if we can get down to this 127 range, just south of that, we would be having a decent margin of safety. Now, my whole thing is this, guys. My goal is this. I want to put a decent margin of safety in our revenue growth because if they beat my numbers over the next, let's say, 10 years, and let's say they do more, let's say they grow 10% a year, the more margin of safety I get, or I give myself, and the numbers make sense, and it shows that there's some green, that means I'm putting myself in a highly possible position to be right and make a decent return on my money, on my investment rather. So with Apple, where does it stand? Currently, it's a little bit overpriced. I'd like to see this price come down a little bit. And our 52-week range, you know what? We missed it just a little bit. We hit 129.04 in the last 52 weeks. So with interest rates rising and the recession that's pretty much around the corner, do I think that this company's price will come down eventually? I hope so. I hope people become a little bit more irrational and start selling off on Apple. That way, once we get to this 127 or just south of that, I can pick up some more shares. At the current moment, though, it is slightly overvalued based off of my numerics here, but listen, you might have different assumptions. You might think it might do higher revenue growth numbers. You might think that the price to free cash flow numbers just doesn't make sense, or you want to change your desired return. Well, folks, this software here will be available for you as soon as I can get it out. I'm working diligently to make sure it's available. There's a lot of things that we offer here. This is the main page. This is the stock specs page, which allows you to analyze companies. It shows you the updated news and everything that you need to know in order to screen a company efficiently to see where it currently stands. We have the income statements, we have the cash flow statements, and we have balance sheets, as well as, if you prefer to see things more visually, we have the charts section. So there's charts that plot out our revenue, net income, and free cash flow versus earnings per share, as well as more features are going to be coming out along the way. So stay tuned for that, folks. There's a lot of things that are going to be offered with this software. It's a great tool, I think so, because it helps me analyze companies within an instant to see where they land. But with that in mind, folks, Apple currently overvalued ever so slightly. I love to own more shares of this company, but only if it's at the right price. So I will be patient. I'll wait for that price to fall, and then I will buy more. But A1 for Apple. Anyways, folks, that's the video. If you want to see a company analyzed, write it down in the comment section below, and I will get to it. So with that in mind, I'll see you in the next one.